This episode of Bright Hearth is brought to you by Joe Garrisi with Backwards Planning Financial, Indigo Sundry Soap Company, Stonecrop Wealth Advisors, and by our supporters at patreon.com. Keep your life free from love of money and be content with what you have. For he has said, I will never leave you nor forsake you. Hebrews 13:5. Wealth gained hastily will dwindle, but whoever gathers little by little will increase it. Proverbs 13:11. Well, welcome back, everybody, to another episode of Bright Hearth Podcast. And again, here we're between seasons on Bright Hearth. And so we're knocking out a few episodes we've wanted to do for a while, but just haven't fit anywhere particular within the season. Before we get into our next full season, where Lexy and I are going to be tackling some subjects I think are really, really fascinating. They're at least fascinating to us. And again, I'm going to leave it mysterious, but we're still looking forward to doing that here in a couple weeks. We'll be getting started. But in this episode, we wanted to drop in and give you, actually, this is a really, really long and detailed episode on a topic that we've been personally thinking through. We've done previous episodes on it and have had a lot of good feedback that it was helpful. And it's the area of financial planning. It's kind of a quote unquote boring topic that is easy to think of as like paint drying on a wall, or it's also a topic where it's easy to get analysis paralysis, as we'll talk about in the actual episode, where there's so many options and so many people telling you different things that you don't know what to do next. And oftentimes we can get paralyzed and do nothing. So we wanted to let you in on a resource we've been using, which is you've heard him as a sponsor of the show, even Joe Garrisi with Backwards Planning Financial. He's a financial advisor, advised, I think at this date, more than 1,500 families over a lot of years in preparing for their financial future. I love the name of his company because it really says what he's aiming to do, which is to plan backward from where you want to end up, and then figure out how to get there today. What steps do I need to take between now and 10, 20, 30, 40, 50 years, my children's children even, in order to hit those targets? And so Joe and I sat down, we talked for more than an hour about all kinds of your basic where to start in your 20s or 30s or wherever you are in getting your financial house in order, and some different aspects of your typical financial plan. So I hope this really benefits you guys and gets you started. There's a lot in here, a lot of different topics that we've covered. And as with any kind of financial planning, there's going to be aspects where you're like, you agree with, maybe you've never considered at all, maybe you don't agree with. But I'd encourage you to listen to the whole thing with an open mind. Do the homework as it comes up if you haven't done some of these important steps. And really remember that in our productive Christian households, we're not just aiming to build wealth, or we're not just aiming to stack up a bunch of dollars. We're not even just aiming to leave an inheritance to our children's children. What we're aiming to do is to be Christians in the way that we think about and execute our financial plans so that our households can do what God made them to do, which is to be witnesses for him, to be outposts of his kingdom, to take ground in every part of what it means to be human. And finances is certainly a part of what it means to be human. And so I really hope this episode blesses you guys here. I'm going to cut into the interview now with Mr. Garrisi. And just one quick plug here before we jump into that. We also sat down after the interview and talked about how to teach some of these things to your children. And we're going to put that short interview on our Patreon channel, patreon.com/brighthearth, and as our In the Kitchen episode this week, along with dozens of other episodes of In the Kitchen that we produce most weeks there on Bright Hearth just for our patrons. So if you'd like access to that, there's a link in the description. Thank you guys for your support and listening, and we hope this interview builds you up in Christ. All right. Well, Mr. Garrisi, thanks again for coming on the show. And we are excited to talk this important topic over. Really, the first question I had, just to set it up, was a pretty simple one. Just what are some of the the essential financial considerations that you think families should be considering, especially in their 20s and 30s?
Well, thank you, Brian. Thank you for having me. It's an honor to be back here again. I love talking about this stuff. In fact, if you allow me to rabbit trail for 2 seconds here.
Oh, yeah.
Is my specialty is in focusing on the micro level. In other words, at the family level or the small business owner level, what should they be doing versus, hey, how should we address our country's finances at the macro level? Of course, I love researching history and especially financial history, and actions have consequences. But my specialty in research is at the individual family level. And so where should you start? Here's the subjects I want to go into today. Where do we start? Credit scores, basic insurance, analysis paralysis, estate planning, investing, budgeting, and kids training. Yes, that's a lot.
Yeah. Love it. Love it.
So yes, hope there's a lot of good information here for folks. Of course, I have to start with, I am not any particular fiduciary responsibility for this subject. Please check with your own fiduciary and your own tax advisor to see if any of these things are appropriate for you.
Yes, good point.
Okay.
Folks, one podcast episode is not going to be enough for you to get your whole financial life in order. Just trying to give you a good start, give you an idea of where you ought to begin in thinking this kind of stuff through.
Yes. Okay, so I am a fan of, if you don't know where you are, then how can you go anywhere efficiently? So I suggest the very beginning is understanding where you are. And that's starting with a list of debts and assets. So normally I would use appreciating assets in this, but in the beginning, it's a good understanding for all assets. So in debt, I'm a fan of Excel just for organization's sake. Include the title of the debt, the balance of the debt, the interest rate, the minimum monthly payment, and what's the collateral or what's backing it, whether it be the home or the car or your word or things of that nature. But if you have debt that's a student loan, right, that's based on you. Or if you have a credit card, that's based on your name. And understanding what is the backing. The more sure the collateral is, generally the lower the interest rate you will receive. Right? So therefore, your word is less sure than a house, because they can come take the house if you don't pay. So this is why homes can have lower credit rating or lower interest rates. And so therefore, you pay less to the bank. In other words, there's all kinds of ways to actually use your own assets as collaterals. There are actually life insurance and investment tools in the stock market that you can use as collateral, so you maintain the growth of those, borrow from those as collateral, use them to buy businesses and houses and cars and all kinds of other things. But that's getting way deeper than the beginning of this conversation. So credit score. The next thing, once you have a list of debts and assets, have a credit score. Now, there are folks out there that recommend not having a credit score. I am a fan of not doing this.
Of not having a credit score.
Exactly. My double negative there of having a credit score. Yes. Why? Because life is a lot easier in today's world with a credit score. For one real basic thing, your cost of your car insurance, which we should have car insurance. I am literally using, this was not in the notes, I'm literally using car insurance right now because my wife was rear-ended. And who she was rear-ended only had the most basic of basic, and she's on disability claim. And because we had full coverage, we're able to get hospital bills covered, type of thing. So having insurance is important. And if you have a good credit score, which is 750 and above, then your car insurance will be less costly, because life insurance companies, car insurance companies use your credit score as one of the tools to see if you are a responsible individual. Not just getting lower interest rates on loans, because the vast majority of us cannot just go buy cars in cash, cannot go buy houses in cash. And so therefore we need loans. So getting a credit score, getting a good credit score will help your life be easier, pay less money to the banking system, and therefore you get to keep more of it yourself.
As a Christian, it's common to feel uneasy about where your hard-earned money is invested. especially when the S&P 500 is full of companies that are actively supporting causes that go against your faith. Stonecrop Wealth Advisors is here to help. Stonecrop offers faith-based portfolios to help you direct your hard-earned investment dollars away from such companies and toward companies that are having a positive impact on society. They also offer comprehensive financial planning to help give you peace of mind about your future that these investment dollars support. Stop investing in companies that want to tear down the things that you care about. Invest in building up God's kingdom while you grow your wealth. Contact Stonecrop Wealth Advisors today by visiting stonecropadvisors.com/brighthearth or by clicking the link in the description. Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. Here at Bright Hearth, we're all about helping you not turn into a girl if you're a boy, or into a boy if you're a girl. You know what might be doing that to you? The soap in your shower. And so we are pleased to introduce you to IndigoSundrySoap.com, link in the description, of course, who can provide you with soaps and more without any of the nasty stuff. And because they love you, they're giving you a discount code, guys. So use code, all caps, Bright Hearth for 10% off your whole order. Support this great Christian company and support Bright Hearth Podcast at the same time. Check them out at IndigoSundrySoap.com. And of course, that link is in the description. It seems like a lot of the instinct, at least behind the advice, wherever I've heard it, of living a no-score life, like having absolutely no lines of credit open whatsoever, any kind, maybe you might have a mortgage at some point and you're paying that off aggressively and that sort of thing. It does seem to me like a lot of that comes from this baseline reality that many people use credit very poorly and very unwisely. And I mean, of course, you and I both would agree that it is 100% possible to shipwreck yourself financially and say, well, but it's going to help my credit score, and fall into the trap. But so let me make sure I'm understanding you right. You're saying, yeah, that's real. I'm sure we'll get into that. Don't shipwreck yourself. Don't live beyond your means via credit and go out and just, what? Mr. Garrisi said that I could go get he said I need a credit score. So I'm going to go get a Lambo and I'm going to commute in the Lambo every day. And my Instagram followers will love it. So
I've heard that similar, actually.
Yeah, sure. Well, it's probably a write-off. Like, sir, you don't have a business. You don't know what write-offs are. Like, but on the other side, prudently using credit in the way that our system is built up. We're not in this episode doing a meta-analysis of the ethics of the banking system, which would be a totally different thing. We're telling you how to live in Babylon.
Yes. Yes. At the micro.
Am I understanding you right there? Yeah. At that micro level here.
What you should do as an individual family. Absolutely. And if you allow me to take this analysis to pick another tool of any kind. Okay. So I have in my hand a pocket knife. Can you properly and improperly use a pocket knife? Of course, right? They're really easy. What about a pen? Can you anything can be used improperly, including a credit card, that type of thing.
My children they've improperly used both of the examples that you just gave within the last week, I'm sure.
Yes. Okay. So how to manage a credit score. Many people don't know how to do this. So here's a great start. There are 3 main credit reporting agencies: Experian, Equifax, and TransUnion. You can reach out to any of them and get a free credit score. In fact, you can do this once every 3 years and get a free report on yourself. So my suggestion is a way to monitor your credit is to get a report from one of them on year 1, the second one in year 2, and the third one in year 3, and just rotate. This will never hurt your credit score if you do it once every 3 years with each of them. So it's a way to understand what's reported on you, what's open, and et cetera. It's a great way to understand that, what's your credit score with them. The goal really is to get 800 plus. When you're at an 800, as a general rule, 750. But if you're at 800 plus and you walk into anyone, they fall over you trying to give you money. It makes life a lot easier if you're responsible. But again, if you have an 800 plus, you're basically telling the banking system, I'm a responsible individual. So here's 10 ways on how to improve your credit score. Okay, first of all, we need to be honorable. That means if you take a loan, you should pay it off. Okay, make minimum payments on all the loans. Okay, so if you do that, you will get a positive score mark to each of the 3 reporting agencies each time you make a payment, because you're maintaining your payment. Using credit cards. Okay, here's one. There's many out there say don't use credit cards. I'm a fan of the responsible people should use tools responsibly, and you will be rewarded for that, right? We're actually told to invest our talents and make positive score and grow them. So using credit cards, as long as you take some rules, you want to use 30% or less of the available credit on each card, because if you use more than that, you're then getting a negative mark. So 30% or less of the available balance, and you want to pay it off in full each month. In full, it used to be. So there's still some that are advising out there that if you maintain a balance on the credit card, it's actually better for you. The laws have changed in that for credit reporting. So it's actually better if you pay it off in full every month and therefore don't pay any interest. The technical term is called statement balance. So you can go to your bank and set up with your credit card to have the bank automatically pay the statement balance. And so therefore now you can get rid of worry of, hey, did I miss it by a day and have to pay interest and et cetera. And then I get a late payment sent to the credit reporting agencies instead of an on-time payment sent to them in a positive mark. So if you just have statement balance done, it's easy. Okay, catch up on past due loans. If you have loans that you've not been paying on, catch up on past due loans. This will improve your score. Reducing your debt to income ratio, so less debt that you have compared to your income, will improve your credit score. Okay. Also, check your report for errors. They're rare. They do happen. But if you check report for errors, there may be some negative entries that you have paid off that you can be removed from your credit report. This doesn't happen a lot, but you can have it. I had this happen to me. I've had significant surgery semi-recently, and they sent the bill to the wrong address. They added an extra digit in my address. I never received it. All of a sudden, I got some nasty grams. And I was like, what do you mean? I pay my bills. What's the deal here? I was able to get it cut up and fixed. They took it off of my report and et cetera. But call and ask. It doesn't hurt.
I think when I was young and dumb, I bought our first, I wanted to marry Lexi, and I was like 18 or 19, I can't remember. And so I said, well, I got to buy a place to live. I bought our first condo, 59 grand. That was how much you could get a place for back in the day. And because I had no credit score at this time, I had to use a private mortgage, just with an individual that was willing to lend me whatever, 45 grand I needed or something. And I didn't realize that being 18, that you had to pay your property taxes every year. And it was a private mortgage, so they didn't do it in escrow. So one year I was late enough that it ended up on my credit report. And I ended up writing a letter to I can't remember what it was, in the process of buying the next home that we bought. Here's an explanation of this ding on my credit report. This is what happened. And it did help. They said, oh, okay, that makes sense. You're not irresponsible. And it cleared it up. But so it wasn't a mistake, but it was explicable. And it did help.
That's a blessing that you had a private person willing to loan you the money. That's not common.
No, my first 2 houses I bought were with private lenders because of my youth.
Awesome. That's a covenant blessing within the covenant people. That's awesome. That was before you were formed, right?
It was.
Any credit card accounts that are not being used will positively affect your score if you don't cancel them. Don't cancel cards, because part of your credit score is the length of the credit that's available for being used. So even if you don't use it, even if you cut it up and throw it away, et cetera, this is one of the reasons why I tend to be fans of credit cards that don't have fees. So you're not creating annual fees on that. You could do balance transfers to get rid of credit faster, or get rid of debt faster. So consider that. But be careful of the 30% rule of utilization. So maybe you owe $5,000 on a card and the credit available is $7,000. Well, if your credit score is good, you can call them and increase the credit available on that card, maybe up to 15 or plus. Now you're in a 30% less usage, right? And then you could automatically get positive scores for yourself just because of that. So there's ways to manipulate that. And if you don't want the available credit on that card, you can call and have them reduce it so you don't have that open credit, because that's when you go to buy a car or a house, they're looking at also available credit. If you have a ton of available credit, they're hesitant because you can still go and charge a bunch of stuff on that. Now, if your credit score is horrible, because life happens, sometimes we get punched in the face. If your credit score is horrible, how do you go and start doing these positive things? Well, one, go get a secured credit card. You can go to your bank, you preload a credit card with a dollar amount, and then once that amount is used up, that card can't be used. But it's a prepaid card. But by using this, you're sending positive reports to the credit reporting agencies. So it's a great way to start, or if you have no score. Now, a little extra idea here, if we're trying to think multi-generationally, how do we help the kids? How do we help them launch? Well, if you are a responsible parent, which we all should be, put your kids' socials on your credit card. So part of a credit score is the length, and what you're doing is starting their credit report long in the beginning before they launch as an adult, and so you're getting years added to their credit score, and so you're giving them a free, better credit report to start.
Yeah, that's great. So people who are, let's say that someone's doing an inventory. A lot of listeners maybe are in this 20s and 30s launching kind of stage. They're figuring things out. Some people might sit down and do this inventory and say, okay, I've written down my debts and assets, and I'm evaluating my credit score. I'm evaluating my financial health, and I am not in a good position. Maybe this just happens a lot. People discover they're not doing as well as they thought they were. Like, yeah, I thought I was getting I knew I wasn't great, but maybe a C plus. And then they sit down, and they go, we have a D right now on the report card. Like, this is, we're spending more than we make. We're living outside of our means. Like, guys, I get it, in inflationary trash world that we live in, and how hard things are right now. People wake up and find themselves in situations like this. What, in terms of a starting point for people who are in a bad debt position, it's pretty simple. They're going to have to pay off their debt, and they're going to have to spend less than they make. But do you have any encouragement or advice for someone who just wakes up in that position, or they do this self-evaluation? What are some things they could do to pay some debt down, maybe get in a better position from there, start climbing their way out?
It's hard to make generalized for everybody because there's so many unique situations out there. So the more draconian you are with yourself, the faster you will improve. So I suggest people be aggressive with themselves. When I'm meeting with many new people for clients, and I ask them to put together their own budget or expenditures, really looking in reverse, not trying to track forward in the beginning of what they're spending. For most people, it's a surprise on how much they spend on different things. And so if you don't, come in the very beginning of what we talked about, if you don't know where you are, how do you improve? So get a clear picture of where you're spending money when you're trying to find ways to improve. I literally was telling folks last week, two different folks I was having a conversation with. One, I said, you need more money. You need a different career. Okay. So, and it was someone a young family, and the wife wanted to stay at home and raise their children, and the career that the husband was in would never provide. And so I was trying to work through with him, what are your skills? What are you good at? And et cetera. So those are long-term things, but those will make lasting improvements on that. But also things like if you have a streaming service, Joe, I pay $5 for Hulu, gone. It's got to be gone. Okay, do you buy coffee? Gone. Like the food, buy bulk food. You've got to find ways to cut peanut butter and jelly sandwiches or tuna sandwiches or, packages of oatmeal, big boxes of oatmeal. Right? Like you've got to find ways to cut spending. And if you're even willing to do more, hey, can you move in with a family member? Okay. For months at a time.
I'm thinking about this on two levels, because there's the thrift side and then there's the increased income side, and both of those often have to happen when you find yourself in a bad position. I have found that people can forget that second side of the increased income side, and they go to the thrift mode, and they find my friend John Moody. He's great, outside the box, productive household, Christian household kind of thinker. And works with Joel Salatin, just great guy. And he made a point I thought was really, really helpful on this. And I've since begun to use it in talking with folks in the church, especially young families who are just getting started on this kind of career, figuring out their financial life. He said, when you go into thrift mode, the first 10% of cuts is easy for most households. Finding that 10% in the budget, it's like, yeah, we don't need this. We don't need this. Okay. And then you go back and you say, it still wasn't enough. We were 20% underwater. And so you go and you try to find that next 10%. And his point was that you hit diminishing returns to where sometimes, and I think this happens with husbands to their wives often, where they say, honey, like the grocery bill's got to shrink by another 15%. And she's like, I already shrunk it 15%. And pretty soon she's spending 3 hours a day couponing, or she's spent, this kind of, and he needs to think often, great, let's keep spending under control. Let's have self-control. That's a fruit of the Spirit. And also for him, let's think about how can I, in my career, even if it's a radical career change, if it's changing jobs, if it's asking for a raise, if it's a lot of young guys in their 20s in my kind of circle, I've told them, hey guys, I know this stinks, but you got to realize most of us who are now in our 30s and 40s had seasons of life in young families, if we wanted our wife to be home, where we were working, certainly true for my family, where I was working 2 to 4 jobs at any given time. So go drive for Uber, go drive for Lyft, and you can add another $800,000 a week in a few nights. If you'll do that, that's obviously not the long term. I don't want guys to be driving for Uber till midnight, 3 days a week in their 70s, of course not. But keeping both of those sides in front of you in terms of awareness, thrift is great. Increasing income is also great. Let's bring them together to serve the financial plan. And that's where, big things can really happen over a long period of time, or over the window of a few years. You look back and you go, wow, we went from a C- to a B+ financially in 2 years, in 18 months. And we did it with, thrift and increasing our income creatively. Is that kind of where you're thinking as well here? We on the same page?
Completely agree. This 40-hour work week kind of, I feel like I should be able to accomplish everything and with a 40-hour income. In today's world, not doable. Maybe in 30 years ago, sure, but not with how inflation versus income and et cetera have treated us. That's a much deeper dive another direction. It's really hard to do it in today. If you allow me to say, in my experience, I've met with over 1,500 families in career doing this financial advisement and wealth management work. I don't know of a single family that's wealthy that didn't at some time have 2 or 3 jobs. So it's just you got to produce, especially when you're young and healthy and energetic and do it. You've got to go. Otherwise, the compound interest. This is, the eighth wonder of the world, according to Albert Einstein, is compound interest. And it works for or against you. And the sooner you make it working for you, the less you have to do. So work more, faster. I know that's horrible English, but so please get a second job. Please cut your spending, but you can't just cut and use that as to resolve your problems.
I do think that, again, I want to reiterate something I've already said. We've already acknowledged that what we're talking about is on the micro level of the family. You and your household, your circle of what you are able to have control over. Now, a lot of people will hear us talking along some of these things, and they'll back up and they'll say, well, but I hate the macro world financially. Like, I hate it. I think there's sin and dysfunction, and there's usury, and there's all these different. And I would say 100%, absolutely. I think trash world is a great name for a lot of the macro picture that we look at, where it is not designed to help men on one income provide for their family. We have not set up our society wisely. And so don't take any of this, again, as a commentary or approval that the world is the way that it is. This is us saying, you have to be real about where you are and what kind of world you do live in. And let's make progress, and let's set our children up so that they can have a beginning point where they have the powerful help of inheritance, and a father who laid up wisely and worked hard and helped get a foothold. And a lot of us are in that first generation carving out a foothold spot. And we wish we had 3 generations behind us that have been wise and laid up, but it's often not the case. So again, don't hear this counsel as like approval that, I would love it if our economy was set up in a way that benefited fathers, having children and keeping their wives home. And, but in our world, you're going to have to out hustle and put in the sweat and be creative and work diligently and heartily. But if you do that, I haven't met somebody yet in pastoral ministry that if they were willing to do that, regardless of what they had in terms of skills to begin with, that was not able to make significant progress.
Yes. I mean, if I'm referencing one of George Gilder's books, the glorious system that we're blessed here in America with is, if you work hard and smart, there's real probability of financial increase. Many places don't have that. We are blessed to be in a place and time that we can do that. I'm going to come back to credit cards just a little bit more. We talked about tools. Tools in their very essence are not good or bad, right? Tools are neutral. They can be used positively or negatively. So evaluate yourself. If you're not using credit cards in an efficient and in a smart way, then check yourself. Hey, you get better self-control of that. It's not easy. I know it's easy to say, it's not easy to do, but it will be better for you. And when I talk later about training your children, how do you want to train them? By what you say or by what you do? So self-control is important here on that. Credit cards are actually a wonderful tool when used correctly, because you get a 0 interest loan on your money for days or weeks. In other words, you get to use the thing you buy now and pay for it later. I think of from my youth, from Popeye, there was a character called Wimpy, and he always said, "I'll gladly pay you Tuesday for a hamburger today." But that's for us old folks that remember the Popeye cartoons. But a credit card is paying later at today's price. And so you get to keep your money, even if you put it in a high interest rate savings account. Right now, there's some that are paying above 5% out there. So you get to grow your money interest-free for some days and then pay it later. If you're smart, don't overspend, etc. It's a wonderful tool that you can use for that. You also can get quote unquote points, rewards. Well, what are those points? The credit card system charges the retailers a fee for you using the credit card. That's built into the price of 99% of things you buy, regardless of how you buy it. That's built into the price. So if you use a credit card, you get to redeem some of those points or cash back or etc. Off that. So you might as well go get some of that back It's there available for you to go get. And if you're a business owner, consider offering a cash discount. Right? Like, I'm not in the retail business world, but if you're in the retail world, look at a cash discount. Many gas stations used to offer this. A few still do, right? If you buy with cash, they will give you a discount on the price. You're eliminating that credit card fee out there. Okay, switching subjects. That we talked about debt and etc. Now, what about assets? So normally appreciating assets, things are growing in value, but listing all bank accounts and properties and retirement accounts and investment accounts and etc. And having this list actually will make your financial life smoother when both spouses know where everything is. Also, when you're doing estate planning, people die a lot earlier than most of us think we will. It happens a lot, unfortunately. But if you don't have a list of even the financial institutions where you hold assets and someone comes to be the executor of your will, how are they going to know where to go? Like, what if they miss a financial institution? What if your spouse doesn't know where X amount of dollars are and doesn't even think to go there? So having a list of your assets will save complications, will make things smoother. And I'm a fan of having things above board on that. I'm going to come back to the subject that you were talking about of being smart with your money. So if you're single and you're looking for a spouse, consider how they spend their money and how are you spending yours? Like, what are you taking into this marriage in fiscal responsibility and what you're looking for? So those are some good conversations to see, are they actually mature? There's direct experience of that. How do they spend their money on those pieces? Okay. And next thing is thinking through goals for that. Okay. If you do not have well-defined goals, then you are relegating yourself to the spaghetti on the wall method. Okay, understanding what you're trying to accomplish, whether it be buying a car or a house or starting a business or retirement or college or legacy, or what are the goals that you have? And then what are the tools that you want to use to accomplish those goals? What's the age you're trying to get to for that? Or what's the value in today's dollars? Where can you grow that money ahead of time so there's less that you need to contribute? So understanding your goals and thinking through them, I find, is a common thing that people haven't done well. And so understanding, again, where you're trying to go. So if you don't have a target, the analogy I like to use is you're like a boat in the ocean. Wherever the wind and the waves will go is where you accomplish or where you will go. So having a target, what you're trying to get to, will help you steer directly to that, on that. Okay, catastrophic issues is where I suggest people start next once they have an understanding. Okay, so someone dies prematurely or someone becomes disabled. Okay, those are the big financial health catastrophic things that can happen. And so I want to get into a little bit about life insurance here to start. There are two main sources of this. I find a lot of people do not understand this. There's individual and there's group insurance. Individual insurance is attached to you, the person. And so wherever you move to, whatever job you take, it travels with you. Okay, group insurance is attached to the company that you work with or own yourself. So if you change companies, that group insurance does not go with you. Group insurance is the cheapest unit of life insurance to buy. And there's a reason for it. Normally in life, you get what you pay for. And this is very low cost. And the reason why is because you have to die as an employee to get that to pay. And the way that most people die is not a sudden event, car crash, boom, you're dead. Right? That's not common. People get ill or injured. They go to the hospital. Western medicine does a wonderful job of keeping us alive for a long time. But employers need someone to fill that role, to do that work. Okay. And if you can't, they will lay you off to free at open spot to hire someone else. And when they lay you off, poof, goes the group insurance and it doesn't pay.
Yeah.
Super common for group insurance not to pay.
So people think they have a great life insurance policy, get cancer, takes 2 years for them to die. The last year of their life, they're no longer employable. Now all of a sudden, their company can't keep them. And companies, by the way, like a lot of them don't love you.
No.
You're not their child. They don't think of you as the second you can't. It sucks, but the second you can't perform, all of a sudden you're gone, and then your $1 million of life insurance or $500,000, whatever you had, is fictional. It does not exist. So it's definitely worth understanding, especially for people who are. I think group insurance is probably most common for people who are working for mid to larger companies that have pretty standard benefit packages, and you sign up day one and they say, hey, you're covered here, and you're like, oh great, I don't need to think about that. Well, maybe not so fast.
Now, when should you use group insurance? When your health has deteriorated and you have not planned ahead of time to get life insurance ahead of time, and now you're at the place of, what do I do now? My health is bad. And well, therefore, go to your group insurance on open enrollment, whether it's your initial or the annual open enrollment, and say, how much more can I get? Because it's common for you to be able to buy more. You pay for it, cheap price to buy more. And it's better to have more there than to have nothing. If you start a company and you have one employee beside yourself, that's not your spouse, you can get group life insurance. That's called guaranteed issue. Guaranteed issue means they have no health questions. Okay. And after you own it, after a certain time period, usually 2 years, therefore it covers pre-existing conditions after that time. So you can still get some guaranteed issue life insurance if you have an employee that's not your spouse. They have to be a full-time W-2, not a 1099 or not a part-time type of thing. There's another kind of life insurance out there called AD&D. People think of it as a group line. Oh, I can get some AD&D, and this stuff is even cheaper. Man, AD&D stands for accidental death and dismemberment.
Pleasant.
Where, yes, it's a very pleasant subject.
Yeah, dismemberment. That doesn't sound pleasant.
No, that's where it only pays if you become dismembered when you die, or if you die because of an accident. I know of a case personally where someone was in a car crash and died. They had AD&D that did not pay because the accident didn't cause it. They had a heart attack right before, which caused the accident. Yeah. So AD&D really almost never pays.
So you're saying that life insurance companies don't want to pay out the life insurance if they can avoid it.
There you go. Understanding. Caveat emptor. Caveat emptor. Not in my notes. One of my favorite phrases. Buyer beware. Right? Understand the insurance company you are with. Are they a healthy insurance company? How long have they been around? What's their experience in paying claims? All insurance companies should be looked at in this way for all insurances. And after that,
because some companies are more likely to pay out than others, if I'm not mistaken. Is that correct? Historically speaking, if you look at their past action.
Right. Look in large numbers, a type of scenario. And how often do they fight? When we're talking lots of kinds of insurance here with lots of kinds of companies. But yes, so like there's a word in the insurance world or a legal phrase called bad faith. Okay, bad faith is insurance company, you were supposed to pay because of XYZ and you didn't. I'm going to sue you. Like some companies have lots of bad faith claims that they lost, and there are companies that don't lose bad faith claims. Why? Why would they not lose? Well, if you actually look at their history, they have a history of paying claims when they're on the edge. So they play instead of fighting. So when they get actually sued for bad faith, it's actually so redonkulous that it actually doesn't come through, type of thing. So getting into two big umbrellas of kinds of insurance companies. This is not life insurance only. This is every kind of insurance. There's two main kinds here. I'm going outside of our notes. They are participating versus non-participating. This is a piece I find almost nobody knows, or very few people know. Yes. Okay. So this is who owns the company. And therefore, that has ramifications because companies, any kind, not just life insurance, companies are there to make a profit for the owners. Right? That's why people start companies, because they want to profit and et cetera on that. So Non-participating companies, another way to be described, are dividend-paying publicly traded companies. You go to the stock exchange and buy an ownership share stock in non-participating companies. It's the majority of them. Okay, from Banner to Transamerica to AIG to John Hancock to all kinds of lots and lots of companies are non-participating. So the dividend goes to the owner, which is a stockholder. So you have a client, you have a company, and you have an owner. You have three parties in this transaction going on. Okay, so the dividends always go to the owner. There's a small subset of companies. It used to be more, but now it's a small remainder called participating companies. Participating companies, you cannot buy stock in them. They are owned by the policyholders. So the dividends go back to the policyholders. So instead of three parties in this transaction, you have two. You have the client, you have the company, because the client is the owner. So they take two parties out of that scenario. So they receive the dividends. So when you look at those companies, who do they do what's best for? They do what's best for the owners. Oh, that happens to also be the clients.
Interesting. I didn't know that.
Yes, sir.
So you would get my auto insurance, USAA, pays out a dividend every year.
Yes, they do.
To a very small one.
Yes.
But, so there are life insurance companies that are like that as well.
Yes. Now, within that circle of dividend paying, another term for that is participating. Another term for that is mutual. So all of those are synonymous terms on that. Okay. There are companies that have mutual in their title that their dividend is so small that it might as well be a non-participating company for lack of dividend. So just because they have the word mutual does not mean that there's a robust dividend to that. You have to look at the financials of the companies. Are they available? Well, for people like me that have licenses with hundreds and ridiculous amount of companies, I can go access all the financials and run reports and show to my clients, look at company A versus company B, and here's their financials for the multiple years, and here's their mortality and morbidity rates, and here's the profitability in the company. And so you then can help decide, hey, do you want to use that company or not? That type of thing. That is... I'm jumping way back into my other notes later on, but hey, that's why you should hire somebody, me or somebody else, whatever it may be, because we can evaluate different companies. Don't just buy the cheapest roller skate out there. Within life insurance, there are times in the legal life insurance world. I have a full postgraduate course on life insurance law. Talk about a riveting course.
Oh, wow.
Life insurance
so
law.
Interesting. Oof. I'm sorry that you had to go through that.
I actually enjoyed it.
There's something wrong with you, sir.
Yes, I'm okay with that. So here's some of the instances where life insurance will not pay. Okay. If you die while committing a felony, I don't care what company you get. These are for universal. While committing a felony, nope. Okay. If you die within the first 2 years of the policy, it will be fully underwritten again. Okay, that's called the contestability phase. It's contestable. Did you commit fraud on that application? Were there some sneaky scenarios? I've had people die during the contestability phase, and guess what? You didn't reveal that doctor you went to. So be careful to reveal everything. Be honorable, right? We're supposed to be honorable in what we do. So the contestability phase. Now, if you commit suicide, but if you commit suicide, some companies have it within 2 years of the policy start date. Some companies have it within 1 year. And so that means if you commit suicide outside of that, it does pay.
Wow, I had no idea that even was a thing.
Yeah.
I just assumed they wouldn't pay.
Yeah, actually they do if you're a certain amount of time. And then I get all the time, husband and wife teasing each other that I'm worth more dead than alive. Actually, you can't in life insurance be worth more dead than alive in normal circumstances, because the maximum amount of death benefit you can go get is a multiplication of your future income in today's value subtracted to a certain percentage of that.
Really?
Yeah.
So you can't go get a $15 million life insurance policy.
unless
if you
you're
don't make enough money to justify
There you go. That's right.
Interesting.
Yes.
I had no idea about that either.
Yes. And then at any time, if the beneficiary kills you, okay, they don't pay out. Okay, it's called the Slayer rule.
That makes sense.
Yes.
Little insurance for, that edgy marriage. We were like, I wanted to get some life insurance, but I don't know. My wife was holding that butcher knife. You guys, if that's your problem, let's go talk to your pastor.
Yeah, there's different problems there.
You don't need a financial advisor.
No.
You need pastoral help.
That's right.
Go get some.
That's right.
Yeah. Oof.
Okay. I want to dive into some different kinds of life insurance. And I have a whole nother postgraduate course just on this subject. So I'm trying to narrow that down into a couple paragraphs here. Okay. So within life insurance, across all companies, there are two umbrellas of kinds. They are analogously titled renting and owning. Or term insurance is renting and permanent insurance is owning. So term insurance, most common thing out there sold today, as far as number of policies that are sold, term insurance is more oftenly sold. That's not always been the case. Actually, term insurance is fairly new time-wise to the insurance time period. Permanent insurance is actually the old kind, and one of them called whole life insurance was the original kind back there like 170 plus years ago when things were getting going in the life insurance world. So renting the insurance is very similar to renting a house. Okay, you get the use of it during that time period, and once your lease is done, you are released from the lease. Away you go, and if you want it again, you have to say, please, please, I would like it again. Can I have some more? And the life insurance company will say, I don't know. Are you healthy? Let's go see. You're older. You're more likely to die just because you're older. So life insurance is going to be more expensive simply because of that. And the vast majority of us do not improve in health as we get older. We more deteriorate in health. So the cost of life insurance for term steps up every time you buy it again, type of that. Now, there is a not so common type of term insurance used. The common type is level insurance, where the price is level and the death benefit is level. The not so common type is a decreasing term insurance, where the death benefit is a decreasing amount. And this is normally used to only cover a debt. Like, hey, I want to pay the house off and I'm paying the house off over time. So I'm going to get a decreasing life insurance that just pays the house off. So that's a very uncommon type, but it is out there. Now, if you look at from an actuarial point of view, you have an increasing probability of dying. And if you buy the most common, which is a level insurance, you got a level premium, level death benefit with an increasing statistical probability of dying. How do you do that? Well, the insurance companies have you pay more in the beginning and less at the end. And they take that overpayment, they invest it, and they use those dollars to pay the premiums you don't at the end when the cost of it is above your premium. But roughly 95-ish% of term policies are not kept until the end. So and there's a host of reasons, like a ridiculous amount of reasons legitimately on why you don't keep it to the end. From don't need it, can't afford it, convert it, and etc. So with level insurance, you're overpaying and then don't underpay. Who keeps the overpayment? Do the insurance company give it back to you? No, that's their favorite kind. Insurance company's favorite kind of life insurance is level term, because they know when their release of their obligation is, and they know if you are normal that you will overpay and they get to keep the extra. So the most common length is 20 years out there. And this is absolutely, and I'm taking 98% of the time-ish, not appropriate for young people to buy. You have your 25, 30-year-old buy a 20-year level term. 20 years goes by, and they still need term insurance because they're not independently wealthy because of all the things we've been talking about. And they need life insurance again. What's their health? I can't tell you how many times I talk to people where their health has gone bad. And now they can't get it. And now they're stuck. And now what do? I tell them, well, you need to make more money. You can't make hundreds of thousands overnight extra. Watch, be super careful. I mean, there's not a good answer to that. So the 20-year level term is normally not the best to buy for young folks on there. There is another kind of term insurance out there that the cost follows the statistical graph of risk. So that means you start cheaper, you're not overpaying. Your payment increases each year by the statistical probability of increase, and it lasts, and the kind that I'm familiar with lasts until age 80. So whatever age you are, the length of the term is until you turn 80 years old. Okay, so it's a lot longer lasting, and it costs less in the beginning. Well, if you look at it later in those years, it's really expensive. Why? Because your statistical probability is a lot higher to die when you're 70 than when you're 25. So that's something to consider, is how to structure it, what company to buy, what additional benefits to buy with it. Like a common one out there is called waiver of premium. Waiver of premium says if the insured becomes totally disabled, which is defined by your doctor at an 80% or greater disability, up to 6 months of time, once they've been disabled at that level for 6 months, the insurance company will come in and waive the premium. Technically, that means the insurance company pays for it. Because if you look at the largest reason why things are dropped besides of just normal, is because of medical issues. Medical issues, cost of living goes up, and the family goes, life insurance or food? I guess we take food, right? So, but this protects the ability to still have life insurance in that scenario, which is an important thing to have in financial planning for families. So that is the main extra that I recommend on term insurance out there. There's another one out there called return of premium. As a general rule, I'm not a fan. And that's because what they do is they extra charge you, and then they give you your premiums back at the end of the term policy. But if you look at what the extra charge was and you did not pay for that, and look at the rate of return on the money, you can actually do much better almost anywhere else, type of thing. It sounds really good. Just pay this, and at the end, we'll give you all your premiums back. But it's the time value of money, right? You could have invested it or paid off debt, or so that tends to be, not always, but tends to be a low return savings tool out there. On the other side, the ownership kind. This is where becoming a participating versus non-participating company is really important, because the ownership kinds have equity position. And there's equity is put into multiple different things. The two primary places are the general portfolio, means where does that insurance company invest those dollars? That's their general portfolio. You don't get to choose that. The insurance company chooses how that's invested, and they get to typically buy things that the individual cannot. Why? Because they're investing millions a month. And so they get special kinds of deals that you cannot, because you don't have millions a month or billions a month in some companies to invest. And those are called the privates world and et cetera type thing. So that's called the general portfolio. The other is invested in sub-accounts that themselves are invested in the stock market. That's called variable. So it's called variable because the equity varies with whatever you've invested in. Okay, and there's lots and lots and lots of choices, from very conservative to aggressive and et cetera. And yes, you can change. So you have invested in the market, or you have invested in the general portfolio. Those are the two primary choices on that. Okay, and if you're with a participating company, they'll add their dividend. So you can use the dividends to pay your premiums. You can use the dividends to buy more insurance. That's called paid up additions. You can use the dividends to go into the cash value. You can use the dividends to send you a check, and you can change every year. So would you like to have dividends or not dividends with those, right? It's when you look at it, it tends to be that dividend payers grow faster than non-dividend payers, just because there's an extra funding source on that. There's lots of varieties here. My goodness, on this. There's a whole life insurance, which has guarantees. In other words, the equity position actually has guarantees on it. There's universal, where the equity does not have guarantees. Okay. There is variable universal. So invested in the market without guarantees. So there's no one size fits all product that's appropriate for people. Or again, like our analogy earlier, Brian, these are tools. Tools can be used inappropriately, and tools used appropriately are wonderful. None of these are for everyone or for different positions on that. So, understanding what you're getting is important, but also who you're getting it with. There's lots of strategies on how to use these. We do not have the time today to go into the strategies of them, but they can be used as funding sources for businesses and retirement and market volatility protection. And I've used it to buy raw land because I had the opportunity to do so at a very good price and I needed money immediately, type of thing. So it's nice to be able to use those when possible. Switching gears, how much death benefit should you get? There's no one universal understanding of that. The most common is pay off debts, pay final expenses, and replace income. Okay, a multiple of understanding that, and there's a lot of math involved. And then we're talking about replacing income. It's how much income for how long, and what is the source? Where would your family live, and et cetera? And what are the other assets that you have to fund that? So there's not just one universal thing, but understanding some basic math of doing what's right for y'all. So here's a problem. Yes, I've given lots, and this is just a little sliver on life insurance. And the problem is analysis paralysis. Most people see all of this and start researching, and their head blows up, and then they end up doing nothing. It is good to have counsel. I have 3 statements in relation to that for you. Plans fail for lack of counsel, but with many advisors, they succeed. Second, the way of the fool is right in his own eyes, but he who listens to counsel is wise. And third, the bitterness of poor quality remains long after the sweetness of low price is forgotten. So buyer beware. Find someone you trust and work with them is the bottom line.
Do you desire to be shrewd financially for your family? It takes wisdom and dedication to build and pass on personal wealth, as mature, responsible leaders must.
Joe Garrisi with Backwards Planning Financial is at your side to integrate investments, debt, insurance, tax strategies, and legacy planning in a holistic approach.
He coaches his clients to act wisely with the resources God expects us to turn a profit on, to love our children and grandchildren well.
Tap on the link to his website in the description and contact him to get started.
Or visit him directly at backwardsplanningfinancial.com.
Trust is the hardest thing in this industry, I think, in this conversation. And really, this is just one little tip of a big iceberg of trust, where Christians have an opportunity to, with in-group preference amongst ourselves, have a high trust network of, with everything, with all, and something that we need to be aggressively pursuing is building high trust networks of people that you really believe that because of your shared value system, that they actually are aiming for your good. Obviously, financial advisors legally in most categories are required by law to act in your best interest to their best judgment. But do you trust their judgment? So this is obviously a huge issue that's kind of unfolding with the collapse of trust around the entire modern world. But that is great advice. Finding somebody that you trust who can give you an outside perspective within an area of their expertise, hopefully, help you from running into that. Analysis paralysis is so real, especially here in this world, because when you look at the financial planning in general, like I'm thinking about my own, and Joe and I have talked quite a bit about my family and our plans, and trying to figure out the future. It's really easy to look at all of the possible things you can do with $1 and then just not do anything, because you're like, who do I listen to? Do I listen to the 401k guy, the Roth guy, the mutual fund guy? Do I listen to the Tesla guy, the real estate guy, the Bitcoin guy? Do I listen to the, the small business guy? Do I listen to the buy apartments guy, the buy land guy? Do I listen to, you go on Twitter and I follow, a few hundred people, and some sliver of that are people that are into some form of financial plan. They probably wouldn't call it that, but investing or business. And it is so easy to end up paralyzed just going. And the reality is, look, there's not just one way to hedge the future plan. So there really are multiple pathways. It's not as if it's real estate is the correct answer and mutual funds are not. That's not how it's going to land. But counsel can help you get out of analysis paralysis and make a plan for your family.
Absolutely. Okay, different subject. Still in catastrophic planning. And that is...
Yay, catastrophe. Everyone's favorite thing.
Subject, riveting stuff.
People are like, man, I fired up Bright Hearth this week and I thought, I hope they talk about being dismembered. I hope they talk about dying of cancer when I'm 39 and, my wife remarrying like someone else. I just really hope that they talk about all that.
Yes.
All right, let's keep going.
Okay.
Let's keep.
Okay.
We've started. We might as well just keep.
That's
going
right.
Through
That's right. Okay. Estate planning. Now, this is not just catastrophic. This is legacy planning, right? And we should be not just thinking of the next generation, but the following, and 7 past that, and 20 past that. And estate planning has both catastrophic and future positive mixed in to it. All right, the basics. Many people don't realize if you don't have your own will, you have one provided for you by the state you die in. Isn't that fun?
I totally trust the state of Utah to do the right thing. It gives me a warm feeling in my heart to consider that possibility.
Yes.
Ugh.
The legal term here is called dying intestate, or without your own testament, that type of thing. So highly suggest that we should all have our own wills. One of the hardest things to make a decision here is if you have minor kids, who is going to be the physical guardian of those kids? Super hard. That changes. Have a conversation with those people. Why? Because if you die and you go to this couple, if you're choosing that, they may say no. You don't want that to then your kids go into the system or et cetera, that type of thing. So talk to them ahead of time. Now, when you're talking to them and say, hey, let's say it's your brother and sister-in-law, hypothetically. Well, brother and sister-in-law, we have done financial planning, and here's our assets to take care of the kids and help you. We're asking you to take care of the kids, but we're not asking you to use your money to take care of the kids. So at least you can be financially responsible for your own kids for them. Consider giving them some out of those. Like if you're going to ask them to take their time, which means they're not spending their time on their kids or going to a job and et cetera, maybe you should consider giving them some of the finances out of your life insurance in that scenario type of thing during that time. So having your wills, who's going to be the physical guardian? Now, fiscal guardian or financial guardian is totally different. I am literally in this industry. I cannot say because people are still alive, because I was supposed to inherit a lot of money and I didn't. How about that for short and sweet? Understanding the fiscal responsibility of that is very important. Money changes people. And so highly consider having a check and balance of having someone else be the fiscal and versus someone being the physical guardian. There are trust companies that do that. We coordinate with them type of stuff. But even if you just have it be another relative, so there's a check and balance in there so your kid's money isn't used inappropriately. Okay, so next is getting into powers, that's plural, powers of attorney. There's 2 kinds of ways to have the power and 2 main different kinds of power. The first kinds are durable versus springing. Durable means in force right now. Springing means it springs to life if certain things happen. Like there's certain kinds of trusts that spring to life if kids are minors and you both die while they're minors. Okay, then the trust springs to life. type of thing. It's a springing trust. There's springing powers of attorney that are not in force until certain things happen. Durable is what normally happy couples should get. The two primary kinds are financial and medical. Many people don't realize if their spouse goes to the hospital and can't make decisions for themselves, and so you show up and say, and prove you're the spouse with marriage certificate and birth certificate and social security card and driver's license and et cetera. I am the spouse. Great. We see that. We agree you're the spouse. Do you have medical power of attorney? Oh, you don't. Okay, so that is what you need to be able to be their advocate and make decisions on their behalf. You need a medical power of attorney. Medical durable power of attorney. Because if you have medical springing, then you have to prove that they're incapacitated. How do you prove it? Go before a judge. So you have to go before a judge while your spouse is in the hospital. Not fun. Okay. So durable powers of attorney. Make sure you ask for that. It's common, but make sure you ask for it to get it done right. And then a medical directive or living will. This is an ethical document that if you're about to die, how do you want to be treated? Continuing on with our great subject of catastrophic planning, how do you want to die?
Love it.
Good stuff.
Yeah. Love it. I would like to be resurrected in glory.
There you go.
Is that one that I can put on there? Like, that's probably not on the medical directive necessarily, more than we have Bible verses on that.
Yes, I was actually reading a piece that Michael Foster did on cremation versus burial, and interesting because of what today's society has gone to. Interesting read to go check that out. And then if you want to get a little more sophisticated, you get into the trust world. Okay, I'm just going to describe the basic trust, but there's lots of different kinds out here. Most people incorrectly think trust is for taxes. Not true. Trust is for control. Control from beyond the grave. Because if your assets just go through a will, whether it's the one the state provides you or you have your own, you will go through a process called probate. Probate is public, and probate takes a while. A year is really common, sometimes longer, on probate. So public, do you want your assets to be publicly known? Maybe not, especially if a husband dies, leaves a wife trying to resolve this with little kids. Let's get your assets out into the public world. Not a good idea. To avoid this, you could use a living revocable trust. Living means it's a legal entity in force right now. It's a legal entity. And so therefore, because it's a legal entity, you can have the trust own things like your house, like your car. It can be the beneficiary of life insurance or beneficiary of an investment account. So you need to fund the trust to make it worthwhile. That's what funding means, is pushing assets into it. But trusts are private and trusts are immediate. Probates are public and take a while. Right? There's your control difference. Another thing you can do if you have minors, while you might want to trust, if you don't have that and both husband and wife die, the kids will inherit their portion when they turn 18. You got 3 kids with $1 million. That's $333,000 going to an 18-year-old. Most 18-year-olds are not fiscally responsible to handle that. That would hurt them. So with a trust, you can delay the release of assets over time while maintaining health and care for them. So therefore, they hopefully mature over age. You can even put things in there to protect special needs scenarios. You can put things in there if they become addicted to drugs, that they need to be clean for X amount of time. I mean, you can put anything you want into a trust type of thing, but you're able to control. So hopefully they use it in a more mature manner. In that. Now, trust costs more money up front, but they relieve pain in the back end. Or another way to please consider this is everybody pays. Do you want pain now or pain later? Okay. Pain while all of us are alive and not emotional because someone died and et cetera can be a very good idea type of thing to get things resolved on that. Any questions on that before I keep going?
No, that's great. I think the key point, a lot of, like you said, people get wrong, is that trusts, they think, oh, it's a way of avoiding, like minimizing my tax burden at death or things like that. But it's mainly you making sure that if you want to leave an inheritance to your children's children, that your assets are doing what you direct them to do. It's not that's mainly what it's for, And also, I thought it was interesting you don't want your will and your assets going into probate because let's say that you had a large life insurance policy and your newly made widow now is public information that she has $1 million or $2 million of assets, and what kind of people might that bring to try and scam her?
So there is a list, at least what I have been told by various attorneys around the country, because I work around the country, is that in every county courthouse, there's a list of people that whenever someone dies in a probate, they get a list of their assets. Now, some of them may be legitimate because they work a lot in finance, and if someone dies, they need to collect on a debt, but not necessarily. Anybody can be put on that list, type of thing. So
that's the last thing that you want is for somebody who's in an emotionally charged death of a spouse situation or family member to be dealing with predatory scammers.
Yeah, grandma who her husband died of 50 years and then sharks come around knocking on the door and she just wants to get rid of them and is willing to pay, right? Making things smart so that way you're not easily taken advantage of. Okay, next layer. Once you got catastrophic risk done, we go into emergency fund. My definition of an emergency fund is two things: liquid and safe. Liquid means you can access the money at a moment's notice. Safe mean you know the dollar number. I didn't say value. I said dollar number is going to be there, right? Because depending on where you put it, some have more or less protection for inflation on that. But liquid safe, you don't want penalties to access that. My normal, please hear normal in air quotes, for W-2 folks is to have 3 months of expenditure, not 3 months of income. 3 months of expenditure in there. The more you have, the safer in the short term you are, but you're not growing the money. So unless you're independently wealthy, you're losing the time value of growth on those dollars. So knowing what amount to have is hard. Generally, the riskier your loss of income is, the more you need.
Yeah, that makes sense. If you're in a high risk career.
Yeah, like pastor.
Yeah, pastor. By the way, I know a lot of pastors listen to this. You might not have realized this, but being a pastor is a high risk career for many reasons. One of them being, in lots of jobs, you can make a 5-minute moral error and still have your job. And pastors, that's not the case. Another aspect of risk is that a pastor doing a good job can in some ways be more likely to lose his job in a lot of church settings. Or if you initiate justified discipline against an influential member of the congregation, there's politics people don't think about who are not pastors. So pastors particularly need to recognize that they're in a high, just like somebody who's a mortgage broker, or, where you have these huge boom and bust with interest rates, and you have to think about these kinds of things in how much preparedness you have and what you need. So it's funny, most people don't think of pastoral ministry as a high-risk career because they're only thinking in terms of like physical safety. I'm not that likely to be killed by a congregant, I suppose. I've probably made some bad enough that they've thought about it, but but yeah, that's a great point. And again, this is why counsel's helpful to help. There are rules of thumb, 3 to 6 months. There's good rules of thumb, but then getting some counsel. What's your actual situation? Have you considered your career dispassionately from an outside perspective? And that can be helpful.
The more mouths you feed, the more you have responsible for you, the more you need. But let's also, if you have things like you're a business owner, which includes if you have rental real estate or things like that, the more you need, because there are more potential uses of your income of that. So there's definitely not just one size fits all answers here. That's too silly on that. And then be careful where you put it. Okay, because different types of accounts have different tax scenarios. There are vehicles that are liquid safe that can grow tax efficiently, tax favorably. There's ones that grow tax negatively. Some beat inflation. Some have always lost to inflation. So there's just not one size fits all, and they're not all available to every person. So what is the right type of tool to use in your scenario? You just in emergency fund planning is good to do some research on, or et cetera. Okay, moving on to budgeting, the subject everyone hates. But I have something at the end of this really quick, which is I think is interesting. But budgeting, or Parkinson's law. Parkinson's law is a business principle that if you to get a business degree, they should teach you on day one, which is work expands to meet the time allowed to accomplish the task. This is with us as adults. This is with kids. This is with everyone. In other words, the longer you stretch out the deadline of a subject, the longer you're going to take to accomplish it. But money is the same. Unless you protect yourself from yourself when you make more, you spend more. And it's generally in the little things. Oh, I can now buy an extra box of bullets. Oh, maybe that's a whole paycheck. No, but
what are you shooting? You shooting 700 nitro out there?
My dream, which I doubt I will ever realize, is to own a Barrett 50 cal. But the problem is, where do you go shoot it?
Yeah, right.
I was asking a guy here in Florida, like, is there any range for this? And he's like, no, you need your own land.
Everyone knows a Barrett 50 is the ideal home defense weapon.
Absolutely.
If you want to defend your home and the next 10 that passes through, you can shoot an intruder 8 houses.
Yes.
Yes. Absolutely.
Yes. When I was
by the way, that's not good advice. Just so you know, I was joking.
When I was in the Army, my gun assigned to me as a tank commander was the Ma Deuce 50 cal machine gun, right? And the sound it makes is intimidating. I have done some training in the military where you're crawling through the mud underneath barbed wire. If you've seen movies, yes. And then around you, they are exploding live grenades. And over the top of you, they're shooting machine guns, M60 pigs and 50 cals on top of your head. Live rounds. Okay. And it was exhilarating.
Yeah. Feel alive. Hopefully your life insurance adjuster wasn't watching.
That's right.
Like,
you were.
What's the actuarial table for this?
Exactly.
Yeah.
You were encouraged to stay low.
Yeah. If you'd like to live, stay low. Oh, good. Right.
But most people, when they think of crawling, they don't actually understand how low they can really get. You need to drag your face and get down low. But you're encouraged that. So no, with the Ma Deuce there, the 50 cal machine gun is the same thing. You were actually taught that it will basically kill any land vehicle besides a tank. That 50 cal round is so powerful that yes, it'll go through like 10 houses. Like you said, it will reach out and touch someone. I don't have one personally. That would be fun. That would be, I need to get a friend with land. That's the best. Friend with lots of land. When I was growing up poor as dirt, I had a friend in college whose dad had a more than $1 million boat. And so we got to go, there was 3 queen beds on this boat. Right. So Lydia and I literally
I need friends like this.
We were scraping, like we couldn't afford food. Like, I'm not exaggerating. And then we had friends at this level. So I need a friend like that now with land that I can go, and with his own Barrett that I can use. There you go.
Even better, a friend with that, that status with the whatever the organization is that they can own the automatic version.
Yes, right. Someone with an FFL. I think that's what they need, right? Federal like firearms license. Yes.
If they get the right FFL, they can definitely own an automatic. Nice. I don't know, maybe a Ma Deuce.
Fun.
That's the friend you need.
I will spend a quarter of my income on a box of ammo.
This is how we, you need to begin any budgeting discussion by talking about ideal firearms that you'd like to own.
Yes. Okay, so there's 2 primary ways to budget. There's the proactive and the reactive way. The proactive way is using Parkinson's law in your favor. Another name for this is pay yourself first. In other words, set aside some of your income to your future self in the beginning and then learn to live on the rest. Because you will self-adjust if you set some aside ahead of time, that's Parkinson's law in your favor. If you do the other method, the reactive method, that's the leftover method. Hey, whatever left over, we'll save. That tends to not be enough. Because of Parkinson's law against you, you end up spending it and there's not enough left over for most people to save for their goals. So proactive or reactive, that type of thing. There's ways, that's a way to help force yourself to spend less unless you're using, like we said earlier in the talk, credit cards inappropriately and et cetera, type of thing. But please be proactive. It's a wonderful. Now, the vast majority, this is my side note, the vast majority of wealthy folks I know don't budget. They've focused on increasing their income way past what their lifestyle is, and then they're good. So if you can increase your income, you can relieve yourself probably of the stress of budgeting, which is my personal fan. I hate that stuff personally. But
yeah, it's the thrift versus income increase thing again.
Yes.
That thrift. Most people who have had the discipline to do that on the one side also have the discipline to where they're not allowing their monthly expenditure to expand ad infinitum, to the edges of, $30,000 a month. I can spend $30,000 a month. Sure. No problem. I just bought land for my Barrett 50 caliber and it's sure.
Okay. So next subject that I'm going to get into, which is how to train your kids to be financially efficient and mature and et cetera through that. But
we're going to do that in the kitchen. Not literally. I'm not actually going to have Mr. Garrisi come to my kitchen, but we do a patron show every week, most weeks at least, where it's a short episode just as a thanks for supporting the show. So we're going to talk about that, teaching a lot of this financial management to kids in that, but just wanted to note that here. It's in the logical spot, but don't think we forgot about it.
Speaking of kitchen, one of my new hobbies that I've had is taking up smoking meats. I've got a pellet grill. I have loved getting into that because I love yummy, quality, healthy food, and I love eating meat. One of my favorite things I did was I bought a 5-pound pork belly, skinned it, cured it, smoked it, and then sliced it up, and we had our own bacon.
Oh.
It was
my heart. Yes, my pellet grill recently went down after 5 years of faithful service, so I'm back in the market.
We need to get you another one quick.
I know.
Quick.
It's a sad day. It's a sad day.
Yes. What? Maybe your parishioners would buy you one, and that would be a really nice.
I'm just hinting here. It's fine, guys. I'll get it.
No, but yes. So I did a brisket. I did multiple pork bellies and chickens and ribs. My second favorite was the pork ribs that we did, a dry rub pork rib. That was like, I want to go make some of those this weekend. So next is getting into, hey, there's lots of different places to put money, right? Crypto versus real estate versus the stock market versus just a bank tool like a CD type of scenario. And one of the things I really want people to understand is there's no safe investment. Just the question is, what risk are you taking? So, and I get commonly, Joe, what about a savings account? Well, even if it's FDIC insured under $250,000, great. But inflation has almost always destroyed the value of growth on savings accounts.
Yeah, absolutely.
So you're taking long-term.
You're $250,000 in 30 years. What buying power is a $250,000 going to have?
Nothing.
A $250,000. I mean, I wouldn't be surprised, guys, if it was normal for a new car to cost $140,000 in 30 years, or if you just do the numbers, it's going to be crazy.
Yeah, it is nuts.
So there's a risk there.
It is nuts.
There's a risk of inaction.
The very first vehicle I bought actually was not normal. This was when I was in college. Was a little Nissan pick-em-up truck. But it had no air conditioning. It had no radio. It had no power brakes. It had no power steering. It had no power windows.
If you crash, you die. That's just how it works. That's the trade-off,
But we
need to get back to making real American vehicles where if you crash, you die.
Yes.
Come on.
There you go, the Pinto.
Give us the option. I know the government is the reason that they don't do that anymore, but come on, Biden, let me have my $2,000 pickup truck with no AC or safety features.
Yeah. That was $7,000. You can't buy that for $7,000 today.
Oh, no way. We're going to be balancing risk no matter what.
Yes. Okay, so a new tool on the market is cryptocurrency, and the biggest one out there is Bitcoin on that. And this has, there's a fallacy in the financial world, in lots of things, but in the financial world especially, where called recency bias. Recency bias is saying that whatever is recently happening is what I think is going to happen long term, not using lots of history and understanding of what's going on. Or if I say it in different words, this time it's different. Or I get here all that time. This time things won't happen like history because of X, Y, and Z. That's probably not true. Of course, things new do happen. But cryptocurrency is a new alternative, new kind of fiat currency. All fiat currency out there is that way when it's not backed by something hard. Like we used to have the dollar and the gold standard. I would love for that to be reinitiated if that happens, and et cetera. But cryptocurrency is backed by nothing. That's a problem. So it is really risky. We've had various fiat currencies in the past. One of the wild and crazy is go look at tulip bulbs back in Holland. That they were used as currency at one time until they crashed. We've had Hummel dolls. We've had Beanie Babies. I mean, we've had all kinds of things. At least they had a little something backed behind them. The dollar is mainly talked about as, this is a fiat currency, but it is backed by the most stable government of the world. And it is used as roughly half of all countries' backup for their currency. So if that fails, the probability is that the world has come crashing to an end, and then many other problems that we have. And doesn't matter where you put your money.
Every fiat currency that's ever existed, barring the ones that currently exist, did fail. I mean, at some point, it's just the laws of reality.
And what about gold in real estate? Do communist countries ever confiscate real estate? In the past,
right? There's risk everywhere.
Yeah, in gold,
there's risk everywhere.
Has the U.S. ever confiscated gold from its citizens? Why? Yes, it has.
Wasn't it? You weren't allowed to own more than 5 ounces.
It's crazy.
Wasn't that the law?
Yeah.
Which, of course, everybody should totally listen to that if they ever try to do that. If you could see me right now, I'm nodding very slowly. I would never encourage anybody to break the law.
Right. So I am. Crypto is talked about as a inflationary protection, a type of thing, because there's a limited number of them. But just it's only been on the market a short time. And when we had this high inflationary world, what happened to it? It crashed. So it's not been proven. The main problem I have is crypto is new and it's not been proven and it's not backed by anything.
Okay, so I know all of my Bitcoin boys are just, their heads are exploding. They're saying Bitcoin is not crypto, Joe. And look, guys, make your case. Tweet at me your Bitcoin case, and we'll listen to it. But it is true. It's new and functionally, I do think there's a difference between Bitcoin and cryptocurrency generally, but definitely think it through. Think it through.
I don't know of someone that has fiduciary responsibility that recommends Bitcoin or crypto. Fiduciary is they must do what's in the best interest of the client. I know lots of people that don't have fiduciary responsibility that are recommending crypto or Bitcoin.
A lot of them are Twitter accounts of partially clothed ladies who are trying to get you to join their Discord and then rug pull you on their scam coin. So,
yes.
Yeah. So when you're thinking about where you're, what kind of general vehicles are people, you go to a financial planner and you say, I need to backwards plan my future.
Yeah.
Okay, we've done some calculation on how much I'm going to plan to need and in what kind of assets. What are the general vehicles that people are looking at for balancing risk versus return,
Sure.
and aiming to make a return, beat inflation, and be
Sure.
prepared for the future.
In most scenarios, I like owning assets, real assets type of things. And there's two primary things of that: companies and real estate. Whether you start your own company, which is extreme feast or famine normally, and mostly famine, and then rare, and then sometimes feast, or you can go into the stock market and become a minority owner of big companies, and et cetera, at various stages, which is ownership of those assets, right? Or you can own real estate in groups, which I do for clients, or you can own real estate in individuals. That's something I don't do for clients. They do that on themselves, a type of scenario where they buy real estate and rent it out, or use it as Airbnb, or just own it to flip, or right. So I like owning assets of things because that's what normally has beat inflation. If you look back over time, assets are what beat inflation. Stock markets have not on that. So that's what I would prefer for the growth desires of people's money, right? The growth portion, not for the safe money portion, but for the growth portion in that. So consider how small of company you want to invest in. Be careful. I don't like all assets into one company. I don't care what company that is, how big or how small type of thing. So be careful. Diversify is important to spread risk out. Well, you may not put all your money into Tesla and have it quadruple over a year or something silly, but you also don't have your money in Bear Stearns when it crashed, type thing, to zero. So diversifying is more sure of success on that. The stock market and real estate have stood the test of time, right? Through all world wars and crashes and et cetera.
Yeah.
As far as order of priority for stock market tools, my suggestion is go get extra income first, the multiplication of your income. And that generally is in two areas. It's a match on a retirement plan, like a 401k or a simple at work. What is the minimum needed to maximize the match from your employer is normally where I ask people to start. Why? Because it's an immediate multiplication of your money. Second, a commonly not efficiently used tool for big companies is in ESPP. That's Echo Sierra Papa, which stands for Employee Stock Purchase Plan, which is the right to buy stock of the company you work for at a discount, at a guaranteed discount, which most companies will allow you to immediately sell, take your increase, and then go and use in your plan. That's a guaranteed increase on your money. It is commonly not known how to use well. So that's a glorious, glorious tool. Now you have to work for a publicly traded company, and that company has to have a stock plan. So, right, that's not everybody that's on there. Okay, so outside of that, again, we're talking in general here to 20s and 30s-year-old. I recommend using Roths, Roth 401ks, Roth IRAs. This is a commonly confused thing. Please bifurcate in your brain 401k law and IRA law, totally separate type of thing. You can do both on that. The 401k, if you're younger than 50, is $23,000, I believe, this year on the maximum employee contribution, which you can do Roth if your 401k offers that. Not all 401ks do. On top of that, you can do a Roth IRA if you have the income right for it, or you may be able to do a backdoor Roth IRA. There's no other ways around it, but you can potentially do both on that. Now, a Roth IRA has a common liquidity benefit that I find most people don't know. And that is, once the Roth IRA or a Roth IRA has been open for 5 years, and open doesn't mean open, but you have funded it. Something's been contributed to and been around there for 5 years. The basis position, basis means what you've contributed, becomes liquid. In other words, you can withdraw, this is a permanent move, out of a Roth IRA, what you've contributed without penalties and taxes at any age, any reason. So this becomes a backup to your emergency fund because you can go access this money. Now, this is not a Roth 401k. This is a Roth IRA. 401k, some 401ks have loan provisions. This is a withdrawal provision type of thing. Now, I didn't say the gain on the Roth IRA. I said basis. Basis what you contributed. The gain does not become liquid until the 5-year roll and 59.5, that type of thing. So you can take out one without the other. You can choose, absolutely, on that. Later on in life, as people are making more money, a Roth is not as obvious because maybe they're in a higher income time of life compared to what they would be later on. And so it may end up being better to do pre-tax or traditional contributions rather than Roth as you get older. And there's a lot of timing and tax brackets and tax deductions like kids at home anymore and what's income standard going to be like afterwards. So there's a lot of various things, but it's not Roth always ever. It tends to be Roth best when you're young on that. But what if you're a 2-income household and drop into a 1-income household? Well, that's not Roth then, because then you're a higher income position versus the future. So there's not one size fits all is where I'm trying to go on that. Okay, and then coming to the question, which is I get all the time, how do I prioritize all this?
Yeah. Only so many dollars, and
Yeah.
Ideally I would have $6,000 a month to achieve all these goals. I only have $1,800 today. What do I do?
Yeah. So I would like to use an analogy of a castle, that I would rather have a king of their castle have their walls at half the desired height, but all the way around, rather than one wall or 2 walls at the desired height and the other walls at the ground level. So sum into all of these categories is what I'm suggesting. Now, in general, attack high interest rate debt first and get your basic emergency fund, get your basic life insurance and disability insurance type of scenario. But there's just not, don't do all of one in spite of everything else, and then move to all of number 2 and then all of number 3. That's very inefficient, and it leaves you at significant risk of attack, like the castle. When are you going to be attacked financially? We don't know. And in what way? We don't know. So it's better in general to go after a piece of all of these over time, et cetera.
And then I've heard you've talked to in our own conversations privately for my family that one of the most important strategies is to do what you can now, and then do everything you can to fix your cost of living, your lifestyle standard. And then as you hopefully mature in your career, have a successful business, get a raise, you're attempting as much as possible to keep your standard of living fixed, and then continue to put that extra. So you're living on that same standard and upping your long-term planning. And this is one of those principles that it really is a biblical principle that wealth gained hastily will dwindle, but whoever gathers little by little will increase it. Is that most of the time for most people, that's a proverb. It means it's generally true in most situations for most people. So, a lot of the time, if you just try to say, I'm going to, in 3 years, get completely rich, you're probably not going to. In fact, it's probably going to be counterproductive for most people. Probably end up taking foolish risk and not hitting that 2% chance that you were banking on that you thought was a 40% chance. But if you're diligent, particularly if you're in your 20s and 30s, even if you're in a not great situation today, if you work hard and you're diligent and you're wise, little by little, you can leave your children in a much better state than you are. You can take care of your wife. The Lord's on our side. And I really do believe that there, especially when you're younger, there's time. But you have to get going, but there's time.
I would commonly tell clients, I help them to get rich slow.
That's a good one. Yeah. Hey, do you want a get rich slow scheme? I've got a get rich slow scheme. Yeah. It's only going to take you 20 to 40 years.
Yes.
But anybody that comes in and promises you, I'm going to get you, give me 3 years and I'll get you there. You're going to be a multimillionaire. It's like, be skeptical. be skeptical when you hear big return, things that violate the laws of reality that God has, again, generally worked into creation. Some people do hit it big. Some people have a wildly successful business, wildly outperforming investment. And sometimes they were really smart and they analyzed and they nailed it. But for most of us, most of the time, it's if you're going to be financially healthy, it's going to be because week after week, after month after month, after year, you were diligent and wise. Well, thank you so much for sharing your wisdom with us, Mr. Garrisi. And there's links in the description pretty much everywhere that anybody can listen to this, that you can reach out and contact Mr. Garrisi if you want to talk more. Again, my family's we've been in conversation and planning for our own. So, this isn't just something that I'm telling you to do, but it's a huge, important aspect of leadership for husbands, for obeying the Lord in aiming to leave an inheritance to our children's children, providing for our families. And like I said, we're going to be talking in the kitchen for any supporters of the show at any tier on Patreon there. There's a link for that as well. Get access to that. There's like 70. There's a ton of episodes for In the Kitchen already there. And this will be the most recent one where we're going to talk about teaching financial management to your kids for a few minutes. And so love to see you guys there. But thanks so much for listening in. Festin Alente. Make haste slowly. We'll catch you next time on Bright Hearth.